Good morning and welcome to I got to get it right, the 108th episode of the Veritas fact-finding series. And today I'm joined by my special guest, Jim Campbell. Good morning, Jim.
Morning, Anthony. Great to be here. It's my honor.
No, it's actually ours. In each episode of the fact-finding series, we go on the ground and speak to industry professionals in an unscripted, candid, live video format to discover how we can better make investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like and follow us at www.veritascorp.com. By way of background, my name is Anthony Scilipoti. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say this year, celebrating 23 years being 100% employee owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, and Jim in particular, this session may contain forward-looking statements, investment opinions, and comments that we may or may not agree with at all. Now, I'm not going to take too much time here because we have an action-packed script set up here. Jim's going to take us through a slide deck which goes through the background of what happened. And the interesting thing about Jim, his background obviously does his BA from Tufts University and MBA from Dartmouth, but he spent his time and become famous as a talk show host on radio and on video. And he's fantastic for his crime shows. Somehow, and he's going to tell us how, he's been able to get in and sit close with felons like Bernie Madoff, his family. He was able to get with, he was the first one to interview former New York Governor Eliot Spitzer, of course, which made famous the whole independent research after the blow up of the tech bubble back in 2000, 2001 that we were all over here, even at Veritas. Then he was the first one to interview now past, of course, Tyco CEO Dennis Kozlowski. So we're here today to talk about Bernie and what we can learn from this experience that you've seen and witnessed and written the book on. We do a lot of training on how to have a forensic mindset. So this is especially exciting for us. Jim, before you get to your script, to your prepared remarks, I'm curious, why do you do what you do? How does someone get involved and be interested in interviewing felons and sharing the story?
You know, I get kidded sometimes that you have to be in jail to get on my show at some point, but that's not wholly true. And you know, I've been fortuitous on that, getting the big crime figures. I mainly do a deep dive show. That's what I hope to be different. And your folks are deep divers in that there's all this shallow talk radio. It's polarized, it's sound bites. And I wanted to do something a little deeper. It started around 2008, which is when the financial world collapsed. So the timing was kind of fortuitous, and I helped kind of explain what happened, because a lot of people didn't know what a credit default swap was and how this thing blew up. And it sort of took off from there. I can talk about how I got into the Madoffs, but you know, I'll be a little humble. Some of these guys, a lot of people don't want to talk to them after they've been in jail. So yeah, I'm willing to talk to these guys.
And you don't get any money from them or share any money. This is purely, you're doing it, you know, to share the good word, really.
No, not only do I not get any money, the Madoffs, Bernie agreed to cooperate with me totally. And he accepted that I was going to A, vet every single word he said, and B, that no one in the family was going to see the book. And the first time that they saw the book or heard about it was the CBS Sunday morning interview I did 2 days before the book came out. So they did never see it, and they were watching to see what I came up with right then or there. So you got to give credit to folks that for some reason trust me.
I asked you this when we were preparing, and you had a great answer. Why would they trust you? Like, why does Bernie sit with you for hours, and then Ruth and Andrew and the rest of his family?
Yeah, you know, it's something that fascinates me to this day, because none of them knew me from dirt, literally. And all of them, Bernie, Ruth, Andrew, Catherine Hooper, who was Andrew's girlfriend and instrumental in keeping him alive. They didn't know me, and they trusted me with their legacies, and to the extent that Catherine Hooper told me that to the depth of her soul, she believed that Andrew did not know or participate, but if I found it, she would accept it. And it took me a long way into it to come to a conclusion there. Bernie, it's a little different thing. One of his big red flags was he didn't have any independent custodians, right? So
Yeah.
you didn't know where the heck whether the assets even existed, which turned out they didn't. And I think he viewed me as a non-independent custodian of his legacy. He was going to essentially pile all of his baloney, lies, whatever you want to call it, to me, and that I would go out and I would buy this, and I would go, clear it up. Because one of the things he said was, Jim, you can clear up all these misperceptions that are out there. It didn't quite work out the way that he expected, though.
Okay. And that's what I was really fascinated is how you explain that your work goes. You're vetting the information that you're receiving from all the sources, looking for an independent corroboration. So with that as an introduction, Jim, why don't you take us through what happened, who knew what, when, who was complicit in the story, and then we're going to transition to what's happening today. We're going to think about things like SVB. We're going to look at FTX. And we're going to wrap this up also with some red flags, things to think about as we're doing our own analysis here, as people on the call are all, involved in the investment industry. Thanks, Jim.
All right, there we go. Thank you again, Anthony. And I must say, I'm very impressed by Veritas. Independent equity research on Wall Street. Independent research is an oxymoron. So obviously, you guys do good stuff. There is a great backstory here. I'm coming from early morning radio, having done the drive time show, get up at 4 a.m. and by 9 a.m. I'm done, and I usually stop on the way home at a convenience place and read the paper and relax. And as I'm 100 yards from there, across my phone, Bernie Madoff dies, and the book is 2 weeks out, and it's really incredible. I'm unheard of at that point, and no one's heard of the book, right? It's not even out. By the time I went 100 yards into the parking lot from when my phone went off, my phone blew up. I found out I was going to be on Bloomberg in 10 minutes. And no one had even told me. And CBS Sunday Morning was trying to hunt me down because they don't want you to go on any other TV until you're on that. And so right from the start, this thing took off. The New York Post asked me to write 2,000 words for the next day's paper, or any length I wanted. And I said, I can't do that. I'm doing too many interviews. How am I going to come up with 2,000 words? He said he would tease it on the front page. So I said, I'll find time then. And boom, it went. Then we hit Amazon 2 days out. Amazon runs out of books and will not take any orders. And we go on the site then, and underneath it is a 6-page version of my book, quoting me, that a guy who's anonymous had put up there, and which was the only thing related to the book that could sell. Then there was another book a few days later called Madoff Speaks, which sounds specifically like Madoff Talks. We ordered the book. It was 120 pages blank. So Amazon has a lot of power, and that was tough to go. But good news, book's still not out. We had 4 production companies come to us to ask to buy the rights for the book for documentaries and movies. And I had to get an agent in Hollywood, CAA, the biggest, and they got me the best director and Netflix. And that's what happened. That first slide is a great depiction they came up with of Bernie, because there's the good and the bad, He had the legitimate business. He had, of course, the illegitimate business 2 floors down in the lipstick tower. And this thing in the first month is going to be seen by 150 million people. The day after it premiered, Jamie Dimon calls me, who is the CEO of JP Morgan. His bank didn't acquit itself very well in the Madoff story. And he couldn't have been nicer. He let me basically interrupt him nonstop because it was clear that I had more information than he did after all these years. And then he started asking me questions. So how did it happen that they would ask me? And I talked to Andy off the record in preparation for another interview. And I got him on the phone because this was in 2011 and he was one of the most hated people in the world. And I started attacking him right away on, you took $3 million from your dad months before this went down. That's dirty money. Don't you think you should give it back? And he surprised me by saying, yes, absolutely. And after we finished talking, he said, I'm going to listen to your show. It was live back then. And if I hear what I hear now, I'm going to cooperate with you. He introduced me to Ruth, who was moving to Greenwich by coincidence, where I live, Connecticut. And we had lunch, and she came into the restaurant with sunglasses on. There was no one in the restaurant. She didn't take them off at first. And she eats a chef's salad like she's had no food. And we hit it off. And she was very nice until we left. And I said, can I get a picture of us? And she said, you're wired, aren't you? And thought I'd set her up. She introduced me to Bernie. Bernie accepted the terms that I would vet everything he said. And I had 3 objectives for the book. 1, get inside Bernie's mind. Number 2, did the family know? And remember, at this time, the Department of Justice, the Southern District of New York, the FBI, the forensic investigator, and the bankruptcy trustee all thought the family had to know. And then the third component was no one had looked at the entire nature of the regulatory failure on Wall Street. And so that first part, what's inside Madoff's brain? And you have to start with the fact that this guy came from nothing in Queens and Far Rockaway, Queens, and ended up breaking the monopoly of the New York Stock Exchange by building the NASDAQ, essentially, architecting the technology that basically brought all the regional and off exchange and pink sheets onto a computer screen, and getting number 3 volume on the New York Stock Exchange, executing trades, leading edge technology for the discount brokerage firms when no one else would touch them at the time. And then all of that with leading edge technology, top level graduates on the 19th floor in what looked like a Hollywood set because he was so OCD. Everything had to be lined up. Everything was silver and black. Every computer screen had to be lined up. No papers left on the end of the day. And 2 floors down, unknown to most people, is this 17th floor, which had high school graduates who he could manipulate, who were unsophisticated, using 1980s obsolete IBM AS400 technology, and basically all paper, looking like it was, from the 60s in there. And of course, the first logical question is, so Bernie's got this great reputation. That business was worth $3 billion, the market maker, without any Ponzi scheme at its peak. So obviously something happened. He lost some money and he made the classic gambler's mistake, right? He doubled down, hoped to get it back. Not ethical, but a little bit more logical. What did I find out? And what did the evidence show? He built both these businesses side by side over the entire time frame. The biggest criminal enterprise in Wall Street history and one of the most ethical. He had the people that he needed, that he could control in each of those profiles. Brain was compartmentalized like that first slide that Netflix designed, and it matched perfectly Wall Street's Chinese walls, where you have walls to protect research from getting to M&A and M&A from getting to traders and all that. And it's why he was able to be the only one that knew the whole thing, saw the whole picture. So the 17th and 19th floors reflected that. He saw himself as a go-to guy that could not say no. So he saw his victims as greedy, as making demands on him nonstop. He always had to be producing positive returns. Saw himself as a good guy, as a people pleaser. And I used to say that, Bernie, the reason you're such a good con man is you're the anti-con man. You have everybody else floating exclusivity. They're the only person that can get to you. There were 20 banks in Europe that Harry Markopoulos had gone to solicit for his hedge fund. 14 of the banks told him that they had an exclusive access into Bernie, and we don't want anybody else. Your fund looks interesting, but Bernie's our guy, and he always produces. Was he a sociopath? He was a narcissist. He never would take responsibility. He had a lack of remorse. He would say to me, Jim, my lawyers tell me I have to show remorse. And, I'd say, Bernie, that's not the best way to show remorse because your lawyers told you to. On the other hand, he ran the business as a family business that was real. He treated the customers upstairs well, never cheated them on anything, paid for his employees' honeymoons, paid for his employees' sudden medical expenses. This is the, and Bernie wanted to talk. He wanted to get out his story to me. And this is the slide that CBS Sunday Morning was always blown away by the correspondent, Jim Axelrod. On that side is 11-page single-spaced letter from Bernie to me. On the right is his confession and apology to Andy Madoff and Catherine Hooper. It says, I'm sorry for everything, Dad. Not even love, Dad. And he's writing a guy he doesn't know that detailed letter. It's really kind of mind-boggling. Let's look at how he did it. First off, a Ponzi scheme means there's no real investment activity going on. And so there has to always be more money coming in the front door than's going out the back door, which is why they inevitably fail, because you can inevitably not keep that going. And how Bernie did it for 40 years is pretty amazing. But he had these big four investors who, were kind of his co-conspirators, the biggest of whom, Jeffrey Pickauer, took out $7 billion. Bernie only stole $800 million himself, so it's very unusual. We had these feeder funds, hedge funds from Wall Street, fund of funds, that were funneling money into Bernie, the guys that thought they were exclusive, that Bernie gave back, which is unprecedented, all of the management fees, the 2 and 20, the 2% and 20 back to the feeder funds. In return, they could do no due diligence. And then individual investors, many of whom were not wealthy, they were middle income, and they were putting money with Bernie sometimes every month for 40 years. It went into this JP Morgan 703 account, which was basically a checking account, and then was supposed to go into his investment strategy, and instead went to the big four guys, propping up his business, the 800 million, and then being used as a piggy bank, giving benefits and credit card access, 50,000 a month spending on the corporate Amex card that was essentially paid for by funds. I want to a little bit into the red flag in detail, but beyond this, the scope of the failure of the scheme was just so immense that for it to go ununcovered for 40 years is unbelievable. Here's an example just on one trade date, which is July 14th of 2000. Bernie would say that he traded almost 8.5 million shares of Walmart. The entire market that day did 4 million. So he did twice the market just in his fund. It's even worse on the options side. This is a May call from 2002 index option. His fake trades that day recorded almost 80,000 options contracts, and the entire market that day was 534, or 150 times more. But
if anybody, I just want to interrupt you for a second, Jim. If anybody has any questions,
yes,
just hover over your bottom over the Q&A. We'll keep them there, and then we'll go back when Jim's finished, and we'll definitely make sure to answer everyone's questions. Sorry, I should have said that at the beginning. Continue on, Jim.
No problem. What I want to do now, if you'll indulge me a little bit, because this is a much more sophisticated audience than I'm used to, as I get asked, well, how do you protect an organization from a fraudster? And the truth is, if you get someone that is this much of a basically sociopathic criminal, it's tough. And he was very charismatic, and he was trusted. He was considered the Jewish T-bill. He was as safe as the government. And so the question is, what do you do? And you know, the thing is that I've found, and we'll see it with SBF if we talk about it too, is the immense amount of red flags that were around this whole scheme that should have allowed it to have been uncovered, regardless of how effective Madoff was. And just looking at and normally I only tell three things when I talk to people. Number one is that this was a split strike conversion strategy, was an equity-based strategy that should have mirrored the overall market. That's all you need to hear to know that it cannot have gone up every single week, month of all of this period, which is what it did. The second thing was Bernie told me himself that the SEC investigators, examiners were in his office, and he told them, if you go to the Depository Trust Corporation, the DTC clears every trade, make sure that the shares exist, and the equities, the securities, and that there's money. And you can take all 600,000 of his trades for the market making business in that year, and you'll see every single one of them. And the account number is 646. And when you're there, ask for a sub account on the investment advisory, the Ponzi scheme, and you'll see the exact same thing. 5-minute phone call. Bernie said this was a Friday afternoon. He expected to be in handcuffs by Sunday. The SEC never made the phone call because they would have found that, yes, every single trade for the market maker could be audited, but there was never, ever a single trade for the IA business that cleared through the DTC. And the third example I give, which is so obvious, JP Morgan was the only entity that had a view into Bernie's financial holdings. And Madoff claimed he had told them it was just an operating expense account like rent and whatever, supposed to be the IA account. They never figured that out. And $170 billion flowed through that account, and which is an unbelievable amount of money. There should have been obviously ongoing counterparty payments coming in and out, right? And there should have been $4.4 billion of dividends deposited over the time period. There was never a single payment to a counterparty or a deposit from one, never a single dividend deposited. And Bernie never had more, he told me, than 5.9 billion in that $65 billion account. So that's all you need to know, that this thing should never have survived any length of time. But there's a ton of red flags, which I'm going to, not go through in detail. But the split strike conversion strategy, which I said, I never found anybody, by the way, who really understood it. Even the traders on the 19th floor, even though it's very simple conceptually. But here's the thing: there is a mutual fund named Gateway that actually runs a split strike conversion strategy that's honest and look nothing like Bernie's returns. I'll show it to you later. So all the due diligence that any of these feeders that are supposed to be doing due diligence across the spectrum of funds so they match up to the right risk profile of the clients. We saw the options footprint, sorry, was bigger. There were never any counterparties. He put these, it was created, these collars on each side to protect the business, which is he wrote calls so that he had premium income coming in, but in the sense he's giving up the upside there, right? To fund buying puts to protect the downside. So the logic appears to hold, except that he gave away all of the returns, essentially. They would be within a narrow band. Secondly, his whole he maintained this was an absolute strategy, right? Meaning, which it had to be in all segments of the market, up, down, whatever, that he could make money. Unfortunately, he would describe to me strategies such as lift a leg by not synchronizing the options, the puts with the calls, which then by definition means you're making a market bet. Prices were outside of the trading range. He never had a single loss ever in a trade because he said he had this gut and he knew when to get out of the market. Well, of course, that's A, impossible, And B, if you're in treasuries for a significant part of the year, how are you making these market returns? You'd have to be making significantly higher imputed returns to get the overall average. The equity fills were unrealistic, and that means the price he bought at, he was consistently buying at the high or the low for the buy or the sell on every day. He said that people couldn't find his options footprint because he was doing off-exchange swaps, essentially. The trouble is that would require the counterparties to consistently lose, since he always won, and secondly, the risk they were taking in the off-market swap would have to be laid off through the exchanges to reduce the risk. On the regulatory side, we know there was no independent custodian. The SEC made 5 separate investigations, never found the Ponzi scheme, never even found the 17th floor, kept reinvestigating him for front running, which is what Wall Street thought he was actually doing, and which, by the way, he was never doing, because he didn't screw clients and he didn't trade to begin with. The auditor was a one-man guy in a strip mall who wasn't qualified to do external audits and was invested with Bernie. And Bernie had his stationery and his tax stamps. No segregation of assets. The focus reports, which are the New York Stock Exchange regulatory reports, were totally falsified and really never looked at. And he never registered as an SEC ADV form, the advisor form. So he never had a SEC money market examination. Only the broker dealer had it. Madoff's bank, to get further into this, major failure. KYC is the know your customer. They have a requirement to do that. They didn't even know that the account was the investment advisory account. They thought it was the market making account, which was at Bank of New York. I've talked about the fact that they didn't look into the account. The 17th floor guys were using obsolete technology. The clients had no electronic access to their accounts, even though they did on the 19th floor. Another big one, there were no live system connectivity to any exchanges. A little hard to do trading. He didn't allow email on the 17th floor capability, and they had no real expertise. He hired the high school graduates. I always thought it was a red flag too, that if Bernie was a master in options, why didn't the upstairs market maker have any options desk? Which it didn't. On the Wall Street side, obviously, I mentioned the fact that the hedge funds, the feeders, pocketed all that, the 2 and 20, in return for not asking any questions and doing no due diligence. Because remember, as a feeder, they were only entitled to maybe a small 1% fee for administering and for picking out funds. So they got to pocket. Bernie was giving up over $250 million a year to them. The other thing they were doing was they were signing a form to Bernie saying, we give up 100% of the management discretion to you. They had to tell the SEC and sign documents that Bernie was only executing trades, which of course was his story, right? That's what he did as a market maker. So they had to know they were misrepresenting. This is what a false statement looked like, which mixes a very official looking form. Those are all legitimate large cap stocks, a Fidelity fund, but were tear-offs from a dot matrix printer, which doesn't quite look as the same level of professionalism. Here's an example of how Bernie, who tried to cover his tracks with all this immense amount of detail coming out of the 17th floor, all these printouts and fake SEC examination response reports. He said, okay, I'm a market maker. I'm not a hedge fund guy. So what you'll see on my confirms, which is what this was, it was commissions. And if you look where the yellow box is, it's empty. So there's no commission there. These confirms, by the way, were in chronological order, beautifully neat behind every statement. And these victims, some of them would actually go through each one and just say, this is just pristine. It's chronological. It's so realistic. Now, here's the infamous Stup account, which is Yiddish for sexual intercourse. And what this was, if you can believe it, on January 1, Bernie would tell you, Anthony, you're going to get 18% returns, which is what this pledge was. Everybody knows, first of all, that's ridiculous to give a equity return guarantee on day one. But come around November, this Stoop report would be pulled out, and they would see that at this point in time, the account through fake trading had made 9.6%. So heck, we got to get this to Anthony for 18. So they would know the fake trades they needed to do at the end of the year to hit that 18% exactly. This is the Gateway SSC fund. That's a real fund. And you know, this is around the 2002 and 2002 to 2000 frame, which is right after the collapse of the internet. And so that's a pretty realistic turn of what the overall market was doing. You look at Bernie's straight 45-degree angle, which by definition is impossible on Wall Street. Those returns, just for fun, happen to be Sterling Equities, which owned the New York Mets, and who lost 300 million with Bernie. The spreadsheet, by the way, just for fun, is that's the actual spreadsheet Harry Markopoulos did to figure out in under 2 hours that Bernie's results could not have been real. I found too that the government did not even go after two major conspiracies. One is that this was a domestic tax fraud scheme. The big four and some of the big clients were getting fake capital losses to offset their taxes. That is obviously criminal in nature. None of these guys ever went to jail. None of the feeder fund guys went to jail. On the right is a woman named Sonia Cohn, who ran the biggest international hedge fund, which ended up becoming a money laundering outfit for Eastern European, Russian oligarchs, Colombia drug lords, a lot of bad dudes. And it was getting funneled into Bernie, where it was then laundered into looking like it was legitimate money. And I got a kick out of it. She even looks like Bernie. It's just, and she was a dangerous person to play with, though. I was told, I was given access to all of Bernie's private diaries, his calendars, and the phone number of every investor. And I was told if I called her, I might get killed. So my wife wouldn't let me call unless there was a day where she was mad at me. All right, let's go over the regulatory stuff rather quickly, because the SEC 0 for 5, totally in silos. As I said, they never had the right level of people, the people who understood how to look at money management and Ponzi schemes, ever look at them. And the broker-dealer guys were totally bluffed by him and Frank, his right-hand man, who was a high school graduate who ran circles. They would be up in the examination room, and they would be down there doing a fake printout. Frank would run down and get it. They'd put it in the refrigerator a little bit so that they didn't know that it was freshly off the printer. Sometimes they threw it around to make it look old, come drop it on their desks, 200 pages, 300 pages, 10,000 records, and the SEC would never look at them. The other, so I call, in other words, they're not a proactive cop. They come in afterwards and clean up the mess. FINRA and SIPC are SROs, which is self-regulatory organizations. And I looked at what SIPC did in this, and SIPC is basically an unknown scandal, but SIPC is the FDIC equivalent of the securities industry. The FDIC was an independent, non-governmental agency that has never not paid a claim or cost the government $1 since the New Deal when it came out. SIPC had been warned 16 years before by the GAO, the Congressional Investigative Unit, that they were not structured to handle a major failure on Wall Street. They did not have enough money in their fund. And it turns out the premiums, which in the FDIC are risk-based, were $150 a year, whether you were Goldman Sachs or a one-man trader through Bear Stearns. So they had no money. And they got back 14 billion of the 19 billion that was the original investment. So they're considered unbelievably successful for a Ponzi scheme. Now, remember, these folks thought they had 65 billion. So the number is really only 22%. How'd they do that when they only had 1.6 billion? They victimized the Madoff victims again. Madoff victims that took out more money than they put in were called net winners. Madoff victims that left their money there were called net losers. They went after the net winners who might not even have that money anymore, right? Because it was withdrawn. And they took money from them, gave it to the net losers, and SIPC took, the SIPC trustee made $2 billion off of that in fees. They didn't recognize the final statement value. So how would you like to get your Merrill Lynch statement? It says $1 million on it. It has investments that originally cost 200,000. And what SIPC said was, we recognize you should get that 200,000 back if we can get it. We don't recognize the 1 million because it was out of a Ponzi scheme, even though there was no disclaimers from the SIPC. And then, of course, those clawbacks for money for people that were innocent and knew nothing about it. And of course, the other big failure is due diligence. And there is no due diligence requires. It can be pure marketing BS, which is what it turned out to be. The biggest feeder fund, Fairfield Greenwich, has a beautiful brochure with all kinds of layers of risk management. And there's tapes of phone calls of the risk manager telling Bernie, I'll say exactly what you want. Yes, we don't do your, we do the trading. You don't do anything, all these kinds of lies over and over. This is what I tell the individual investors, which is don't invest in stuff you don't understand. No one understood it. Don't assume the government's going to bail you out. Don't assume SIPC's going to bail you out. So take responsibility for your own actions. This was an affinity crime, 85% Jewish people and charities. So don't do what your dentist tells you to do, or some affinity group that doesn't really understand this. Obviously, don't believe guaranteed investments. And, Bernie at the end was given around 11%. The market's done 9% compounded for 100 years. So, I said, put your money in a low cost index fund, take the 9% and sleep at night. All right, I'll stop there on the whole Madoff story and open it up either to questions or whatever Anthony wants to go.
I got a couple questions. To be clear, there was the big four, there were the feeder funds. Based on what you said, the feeder funds knew, the big four were aware of what was going on and were profiting.
But that's a really good question. I broke it into four co-conspirators. The big four,
yeah,
the willfully blind, which is a feeder, the unwitting, which is the SEC, and the witless, which is the 17 floors. None of them knew it was a Ponzi scheme. The big four knew they were doing all kinds of illegal stuff, backdating trades. They knew that Bernie had shortages of funds every now and then, and that's where they were bailing him out, and then they could extort returns from him. But they wouldn't have kept their money there right until the end if they knew it was a pure Ponzi scheme. And it goes the same through all of that. It's hard to believe. You cannot believe any of them didn't know, because the SEC is just as culpable, missing 5 separate investigations. But nobody knew. And my investigation on the family, by the way, is in chapter 8.
And can you, so none of those, let's call them involved important entities, those four that you mentioned, none of them knew the complexity of the Ponzi or the fraud.
None of them knew, that it was 100% fake and that it was a pure Ponzi scheme.
I love your point about the affinity groups, and this happens very often. I find.
Yes.
Is that we get sucked into things because we're like, well, Bob's doing it, Mary's doing it, and we see each other at shul, we see each other at the bowling club, we see each other at church, we're involved in the same hockey team. Everything's got to be okay with this. And Bernie was, as you mentioned, he was a gregarious guy. He was a likable guy. He ran a business that people said was impeccable. And because of that, he was able to shield the other.
Let me tell you something else too. Human beings want to believe too good to be true. And
Yes.
this is where these Ponzi guys are very successful, because, and they always are the same. We guarantee you a return. It's guaranteed, usually within a couple of months, and on and on and on. So it's always implausible, but people want to believe it. And then you throw on exactly how trustworthy this guy was. And you could see, and I joke about putting dentists up there. I hear all the time of dentists say, we're in this limited partnership.
Yeah.
They have no clue what the investment is. But you got to do it, and by the way, a lot of people suspect that Bernie was up to something, and they'd say, maybe he's front running, maybe he's doing something crooked, but he's our crook. and we're just gonna look this way. And then there were all the innocent guys who just believed that while we don't understand it, he's the Jewish T-bill.
You mentioned chapter 8. Do you want to not say whether the family actually knew or which ones?
Yeah, no, I was
of them do?
I want everybody to run to the bookstore. No,
okay, well,
no, it came down to, and I went through all the reasons, right? But the big one was Bernie laundered $800 million from the 19th floor of that JP Morgan account in through the Bank of New York, which is a market maker, into the back door of the market maker, into the trading P&Ls, right? Where they were hidden to beef up the firm when they were having liquidity or profit problems. Here's the problem with that, though. The market making desk was run by Mark Madoff, and the proprietary desk was run by Andrew Madoff. Bulk of it eventually was put through the proprietary trading. So that's why nobody believed that could have happened without them knowing about it. So I had to go about trying to figure out, because I had a problem with the proprietary desk was like 25 to 30 people. You're going to lose $800 million over 10 years and not do anything about that? The scope made no sense, but you got to throw that out because everybody, and the forensic guy even believed it. What I found was that Bernie, the CFO and right-hand woman, were essentially creating these fake trades at the corporate level after the P&Ls traveled from the desk. So that what Andy and Mark were seeing were the real P&Ls. They had created fake traders with names that didn't fit the nomenclature. And the key thing is I found a deep throat. There were only about 6 people in the entire firm who saw the real trading P&Ls. And you have to rule out Bernie, obviously, and the CFO. And to find someone that saw them who was honest. On the proprietary trading, there is one person. And he validated to me that the biggest loss ever was $10 million in a year, which was 2008, the last year. Otherwise, they were profitable. The market making desk never had a negative year. And so the 800 million was not trading losses. In fact, they were hiding it in non-trading areas before they went there. But it didn't look good. And, so I had to get comfortable with that. Ruth also is a little uncomfortable because this will blow people away. She was balancing the 703 account up until the final year. And people will say, well, then holy cow, she saw all that. No, what she was really doing was balancing a checkbook like you would do, ticking off check 5, check 6, does it match this? She wasn't doing any analysis on it. And she turned it over to the CFO eventually because it was too much for her to do. But, so things didn't look good on the surface. But the fact is they did not know. Bernie was using them as what I call the front of the restaurant. He wanted that business run totally legitimately, no footfalls. Even if they got small little infractions, he would self-report it to the SEC. So Andy and Mark were the credibility, the guys at the front of the restaurant, while underneath on the 17th was where the mafia bad stuff was going on. In fact, the boys never went to the 17th floor other than a few times in 20 years. And they did not even know who these investors were, the guys that were coming in and that Bernie had recruited for the investment advisory firm. Very sad story. When Bernie told them, admitted to it the day before he was arrested, the boys did not pause. They did not go to move their money out. They did not go to leave the country. They left the apartment to get to the lawyers to find out how they could turn their father in to the FBI. And Andrew never spoke another word to his father for the rest of his life. I used to tell him, talk to Bernie for yourself for closure. And he would say, never. I'll never talk to him. He's dead to me. He killed my brother quickly and he killed me slowly. Let me tell you something else. Mark Madoff committed suicide 2 years to the day after Bernie was arrested. And Eleanor Scolari was Bernie's right-hand woman. I'll talk about her a little at the end. Her daughter, on the night that Bernie was arrested, just 2 hours later, she had worked as an intern with the boys, the Madoff boys in high school. She told her mother that Mark is not going to be able to handle this And within 2 hours of Bernie being arrested, she said this, and he would kill himself. And he did. Andrew died of leukemia that had come back that he'd had in 2006. So Andy said, my dad killed me slowly and my brother quickly.
Wow. Ruth is still alive today.
She's still alive today. She still lives in Greenwich. She did not want to talk to me as I got close to the book coming out. I think because, and we got very close, by the way, texting, talking, we'd have regular lunches. I think because they were trying to get Bernie out for early release. But I was told, I gave her a signed book through her lawyer, and then she has the book therefore, and she watched the CBS Sunday morning interview.
It's
interesting where they asked me that question that you asked.
Yeah, I'm going to just try to wrap it. Last comment here, and then I want you to take us through what this means to what we've seen in the Silicon Valley Bank, FTX, and possibly other risks that you see in the marketplace. But what I think this smells to, and I want people to listen to this part, is that we're sophisticated. So, look, I'm a forensic accountant. When I look at a set of financial statements, I don't ask too many questions. It's like, oh yeah, I see that. Yeah, I've seen this before and I've seen that before, and that makes sense. And, I trust that guy, that CFO over there that's running that business, and the CEO, I know them. I've seen them before. And we do this as analysts because when we see things that are common frequently, we overlook them. And that is where we make the mistake. That's why I love hiring individuals that don't necessarily have experience in the space, because they'll ask what are naive questions, but it's in those naive questions that you find the interesting answers. My father never went past grade 6, but he built a business of several $1 million, sold it, and did really well. And he always just asked what he called stupid questions. He says, so explain to me again how you make these sales and how you make these parts for he's a furniture manufacturer. And he always asks these, what he calls stupid questions, but they're just the ones that, experts would never have asked Bernie, because to them, oh, Bernie's just a trade. He's got this great clean business. Yeah, we trust that he'd be able to do these type of trades because that's what he does. Yeah. And then the last point I want to make is these self-regulating organizations. I think if I take this to Canada, where I see concern today is in the private space, the private lending space, related especially to real estate, as we've seen in our marketplace. And we've seen some, obviously we saw Fortress blow up a few years ago. I'm concerned that there could be some other players in that mixed space that who knows what happens. Anyway, that's my commercial message. Jim, take us through FTX.
I will, and I'm going to give you guys the slides. Look at those red flags again, because as Anthony was saying, most of these are incredibly obvious. I mean, basic. And remember, this went on for 40 years, 65 billion. I say in the book that absent the 2008 crash, Bernie would still be in business. Okay, is FTX Madoff 2.0? And some interesting parallels. First off, I said Bernie had unprecedented trust in the industry, right? And he was chairman of the NASDAQ for a while. He was on the short list to be the head of the SEC at one point. This guy, SBF, right? He comes in and he's one of the only crypto guys who says, I want regulation. He spent 70 million getting closer, giving donations to politicians, mainly Democrats, on Capitol Hill. He had ex-regulators working for him. He had this image of altruism, which was his philosophy. Here we go. He had built up the same kind of, and it was aw shucks. He's in his shorts and his bushy hair and everything. Yeah. And the same kind of arrogance and lack of remorse. And why do I say arrogance and lack of remorse? Basically, his story so far has been the dog ate my homework. And think about that for a second. You start looking at what was going on, the commingling of customer funds, $8 billion, the exact same thing Bernie was doing, the biggest single no-no on Wall Street, right? Into a company that was essentially a hedge fund that he owned, okay? Which is then being used as collateral for loans of that business, Alameda, even though that's customer money, okay? Now, let's see how smart this dog was. Yeah, he had a $1.3 billion collateralized loan with customer money to SBF himself. He had the system programmed so he got charged no interest on that. So he's stealing his customers' money and not even giving them any interest. And somehow the dog did this. And you know, we have the same institutional failure of due diligence here because Sequoia, BlackRock, um, SoftBank, some of the biggest funds had money with this guy and no controls whatsoever. The auditor was a joke. He was running the accounting system, I think, on QuickBooks. Almost mind-boggling. So he lost what was it, $30 billion of equity value in the FTX exchange. Yep. He lost $3 billion of his customers' money. He had 1 million creditors, right? So Bernie had 700,000 victims in Europe, 16,000 in the US. It was a $65 billion scam. So I start seeing a lot of similarities. Was it a Ponzi scheme? No, because there was real investment activity. But what was going on? The token that underlied the FTX exchange was called FTT. That token had to be maintained in a pretty stable value, right? Because he had all these loans that he had taken out off of it. So there's some evidence, and there are allegations that there was market manipulation going on to keep the FTT token stable, as well as destabilizing some of the competitive ones. That's stuff that Madoff didn't even contemplate doing. If you look at this, so let's look at the two. Failure of due diligence, is obvious as history repeats itself. But look at these other things. The commingling of customer assets, that was a huge Madoff, and MF Global, if you guys will remember, the former chairman of Goldman Sachs and governor of New Jersey, John Corzine's firm. Market manipulation, self-dealing. The guy ran the FTX exchange, he ran Alameda. He's essentially dealing with himself, right? With customer money and all kinds of excessive debt leveraged off of that collateralized debt on a currency that as soon as that FTT token went down, everything was going to be a run on the bank, which was like Lehman, which is what happened. Archegos is a family hedge fund that had taken out all kinds of leverage from different prime brokers, none of whom had spoken to each other. That was cascading risk fallout, which is exactly what happened in the crypto market. And, crypto's down like $2 trillion. And then finally, Chesapeake, which you may not know is a firm, the CEO there got himself on huge margin debt on the company stock. And obviously everything collapsed at the same time. But here's the thing, every one of those I see in FTX, not Madoff, but FTX, every single one of those. So the sad thing is that why does this keep happening at this scale, right? Where's the SEC? Where's the CFTC? Where's the due diligence that would allow something to have absolutely no controls, run like rubber bands or something? I don't, and then have the guy just prance about. He was doing interviews after this happened. I mean, you talk about arrogance. All right, if you want to, let's do SVP, and then this is another one that to me is mind-boggling. First off, everybody knows risk management 101 is asset liability matching, right? So we're sitting in this environment where interest rates have more than doubled, right? And everybody knows that. And you happen to have a portfolio that you call hold to maturity, bonds that you're not marking to market, you're not that are not turning over. So obviously, what happens to the value of these hold to maturity bonds when interest rates double? They go down. In fact, they went down $2 billion in value, but they're hold to maturity. So if you don't have to sell them, you're all set. Except we have asymmetric risk set up. They've loaded the bank. In fact, they doubled their deposit base in the final year with what I call hot money. But the ratio of uninsured deposits right above the 250, you have to monitor that, and you have to understand the behavior of it. How hot is it? How sticky is it? Okay. They didn't understand that because they had grown it too quickly. But here's the thing. On the asset liability mismatch, they knew they were underwater and they knew they had hold to maturity, right? but they were, but that wasn't being recognized on the P&L. Okay, there was no mark to market, no gain loss. Okay, so there's no pain from that, but they're taking all the coupon interest payments into the profit P&L to show that, and they were very aggressive on their profit objectives. So essentially, they're hiding a huge level of risk to take short-term profit, asymmetric risk, and should have been, readily apparent. Then on top of that, they'd aggressively increased their deposit base with money that was going to take off if there was any risk, right, that the bank was going to go down, which is exactly what happened. The board was very weak. Management, even in the month before, had exercised options and things like that that don't look good. KPMG, who I used to work for once on the systems integration side, 14 days before the bank no longer even existed, had signed off on its books. So, and this came out of the blue, right? And we're all stunned at everything. And then you break it apart. And then, of course, what did the government do again? Bailout, moral hazard impact, and has basically nationalized deposit insurance above 250,000, right? Because we can't stomach the risk of if this cascades through the whole middle market. And by the way, the stress tests that were part of the Dodd-Frank bill were taken off of the middle market banks, which would have shown that up. Make it even worse, Signature Bank in New York that went down with SVP, guess who was on their board? Barney Frank from Dodd-Frank. It's like you almost cannot make this.
You can't make this stuff up.
No. Now let me just say that you brought up the point on other stuff. When I say the SEC is not a cop, my book came out 2 years ago, right? And so I'm thinking to myself, here are the things that could probably blow up over the next period of time. And is the SEC on top of any of them? Well, crypto, we obviously know to this day has no store of value, supports the dark web and all of the kind of stuff that's listed there. And there's still no regulation, right? Yeah. And commodities are regulated by the CFTC, which reports to the Agriculture Committee, what does the Agriculture Committee have to do with crypto? SPACs was another one. SPACs was highly popular when the book came out, and it allowed firms to avoid the S1 and get a simplified IPO out to the market. A really good idea, right? Except there's no enforcement at all of due diligence in the SPAC, and you can actually completely make up your financials. And then I have a problem with what's called the promote, which is the incentive to get investors in, screws the clients when you go to the market because they take too much. Robinhood was one of my huge bet noirs. They're advertising to people to trade as much as you want and it's free. Well, how is it free? Well, it's free because they're pocketing money for directing order flow. Yeah. It's called payment for order flow. You know who invented that? Bernie Madoff.
I was going to say that.
Bernie did not cheat his customers, ironically, though, because they have a fiduciary requirement to get the best public price, right, to their client. And then you take some fees for directing, and he didn't cheat the clients. Robinhood was cheating their clients so badly that they were paying more than if they were paying full commission. And this is guys who claim they're taking on big bad Wall Street. And I throw the derivatives on for the end because they're the next one that's sitting out there. Dodd-Frank was supposed to get derivatives onto an exchange, right? 58% of derivatives, and there are like 195 trillion in the world right now, notional value, are still not going through any exchange. So none of these things have really been looked at or gotten under control or have a regulatory framework. So things haven't really changed.
So as you look at, and I just want to make one point that you mentioned that on Silicon Valley Bank, that there was no way to see what was happening on the risk. I do want to point out, and it's something that we wrote about, if you look through other comprehensive income statement, you'll see that the value of those held to maturity bonds or securities would have been marked to market, but it doesn't go through the income statement. But right. They did show what the impact was. Right. It didn't go through the income statement, and there was no impact to capital. That was the important thing,
Right.
that the dot-com or the sort of the hivening off of banks with less than 250 billion in
Yeah,
capital.
that was $1.8 billion of unrealized losses.
Right. So if we pull this together, you're thinking that these are sort of the four buckets that you still see as potential blowups. Look, the SPACs have pretty much blown up already.
They've already
There's not
blown up.
much left.
And Robinhood has blown up to an extent, although trying to tell people that rapid fire trading is a way to get rich is one of the dumbest things that you can tell somebody if you care about them, if you're trying to get people to do it. And, you know, the SEC needs a cultural change, what I call it, to more of a proactive, to be proactive, you need a culture change as well. It's not just, you know, how you check off boxes when you're at examinations. You have to have, you know, intel on how to get ahead of this stuff, right? And then have the right talent. They didn't have the right, forget that they didn't have the right examiners in terms of looking at the investment advisory. Even in the broker dealer, they had young lawyers who didn't understand trading, who were only interested in punching their clock to get jobs on Wall Street, right? So they wanted easy cases that they could check off quickly. All of those things work against seminal black tail, big kind of, you know, market collapsing risk. And then to have the same things happen over and over again, you know, every 10, 15 years, you know.
Here's the thing, Jim, you know, and I have a lot of respect for the regulators. It's a tough job.
Yes.
But oftentimes there's more money to be made working for Madoff and protecting Madoff, if I can go there, than there is going after him. And going after, you know, so much money was made spinning out those SPACs.
Yes.
There's so much money being made by those organizing Robinhood. And this whole derivative point that you make is unbelievable. The amount of zero options that are being traded and moving the market, and short dated options. I think that's going to be a whole other can of worms that really, unfortunately, people think it's a fast way to make money. It's an even faster way to lose money.
Yeah, and it's just hanging out there as an obvious exposure. And I will say you're exactly right. Madoff used to get examiners handing them their resumes.
Yes.
When they were doing it.
You know, and I've done some expert witness stuff, and I feel bad. It just, I think we need to rethink, you know, because there's the agency problem too. We need to rethink how much regulators get paid, and the type of weapons that they're given, if I can use that, because, you know, it's just like if we're fighting crime. If I go with my handgun and the criminal's sitting with an Uzi, we got a problem here.
Yeah, you know what? And then what I say too is the SEC does, first off, it finds you guilty, right? You have to sign, you're able to sign something saying, I have made no admission of guilt and I'll pay a fine with shareholders' money. How is that a disincentive? I would have done on Robinhood, the CEO would need to be taken out of that job. They're not allowed to be in the industry, and they're going to be clawbacked. And down to their home on Long Island in the summer if it needs to be, because when you start doing that, you're not going to have bad behavior, okay? Because people are not going to want to have their livelihood clawed back. But when you can say, okay, yeah, we didn't have the right controls in, I'm not admitting any guilt, you know, and then you go back to business.
Yeah,
there's no disincentive there.
But it does take, I think you have, given the types of interviews you've done and the work you've done, studying the human element. As I listen to your description and depiction of both Madoff and if we look at the FTX individual, there is this sense of non-remorse, this sociopathic type of personality, and I think that's why, you know, I learned this from private investigators, is kind of, you know, companies don't run themselves. They're run by people. And so you need to understand the person. And while, you might see that that person acts a certain way, that seems prim and proper, you need to follow them home. See how they're running through stop signs, how they kick their dog, beat their wife, beat their husband, don't pay attention to their kids. All that sort of thing is intertwined to understand what's really going on at the company.
Exactly right. That's a good lead in, if you let me just
I want you to leave us with sort of the things to watch for. And if anyone has any questions, again, I'm going to make that point. But as we're wrapping up here with you telling us sort of, here are the things to watch for so we don't miss the next scam, leave us with that, Jim.
All right. Well, the message I have is actually leave finances alone for a second and the complexity of this story. Because it's really nothing more than almost a Shakespearean morality tale about staying on the right path, okay? Because the first thing is, when you do something like what Madoff does, you're going to get caught. Millions of dollars were made by him, by his staff on the 17th floor, and all of them ended up in jail with no money. And I used to look at this. Eleanor Squilleri, who I mentioned, was Bernie's right-hand administrator on the 19th floor, and Annette Bongiorno had the same role on the 17th floor, right? Eleanor made $125,000 a year without an IRA and was totally honest. Annette, her final salary for the same job, essentially $670,000, a $58 million fake IRA, and Eleanor and Annette came in the same time. And Eleanor was haunted by what made her take this path versus that path. And that's the thing that gets lost sight of, I think. And Bernie grew up in a shadow of failure. His father had several bankruptcies. He admitted to me he didn't have the moral courage to end the thing. And so I dedicated the book to my wife, but also to my dad, who gave me that moral foundation that Bernie lacked. But in a company, the values come from the top. There has to be a moral foundation and a fiber beyond the P&L, beyond making your numbers, because otherwise you're going to do whatever it takes to make your numbers. And independence, avoidance of conflict of interest. One of the problems I have, Wall Street, I'm a big fan of Wall Street, brilliant people in it, but there's too much institutionalized conflict of interest versus the customer. And you got to have the same interests or be paid on interests that benefit the customer. And it can't be done in all cases, even in the merger department, for instance, they only get paid if a deal gets done. So what do you think they recommend?
Yeah.
Right? And 50% of corporate marriages fail, just like human being marriages fail. So they should be giving advice often to say, don't do this, don't do this deal. But one thing, as I say, in all of this, the flags, the evidence, the signs are always there. And in retrospect, they look obvious. They don't in the beginning because the guys have credibility or they're believable, or you think people believe the SEC was on top of this stuff. That, if the SEC's vetted the guy 5 times, that's all I need. That's the housekeeping, seal of approval. But no, that isn't the right thing. And I would say always that you guys in Veritas are a good place to start in the fact that you'd go in with independence and you do the due diligence.
Yeah.
And so if you don't find it doing both those things, then the guy's a really good criminal.
And here's the thing, and this has happened in many of the cases that we've worked on, whether it was Nortel or BioVer or Valiant or
those are big ones
over time. And it's that they can occur for a long time, and they lull us into just this. Well, look, if I know you said these 5 things were a problem, but look at how great the results are. And that happened last year and the year after, to the point that, sometimes you guys are just crying wolf. And I like to make the point that when you're looking at these small details, they don't matter until they matter. And then when they matter a lot. I want to just quickly launch our poll here so everyone can tell us what a great job you did, Jim, for us today. And I did get a question, so I want to make sure we address that. Ankit, thanks for the question. There's been a lot of companies who report official filings one way, but then adjust their figures, whether it's EBITDA or adjusted earnings or otherwise, that the street circles around for consensus and measurement analysis purpose. Is this a risk at all? And do you know if anything is happening by regulators or failures yet? It's amazing. This is like so near and dear to my heart. I think I could have planted this, but I'm going to let you speak, Jim.
I do see it as a risk because the underlying business cannot be healthy, and you can get away with the EBITDA type measures, and so it can mask the underlying business. The thing that I always want is I want ultimately a P&L that reflects the economics of the business, right? A lot of P&Ls, the guys in the company have no idea where they're making their money from.
Right.
And I am a believer that you should know where you're making your money from, and which involves a lot of allocation kind of stuff and whatever. But I'm always skeptical when the first thing is they throw away the GAAP results, or they try to don't even look at the GAAP results. On the other hand, I look at Buffett is my hero, right? And he has to mark his income statement to his unrealized gains and losses, right? And that makes it almost irrelevant to look at, right? Because he's got such a huge portfolio that he's never going to really trade much in. And so the earnings go up 40 billion, down 20 billion. So he shows operating earnings, and I buy that. But he doesn't believe in EBITDA, right? Because EBITDA can also mask stuff, especially if those returns are not really providing an economic return besides covering your interest, expense on being over leveraged. I do think people play with whatever they can get to show what is best. And
I think, if you tell me if this makes sense, and I wanted to try to pull based on my experience, you mentioned we all as investors, we want positive. We buy, the amount of momentum that's behind stocks going higher, earnings going higher, revenues going higher, it's built into everything we think. We think everything's always going to go up. And when it doesn't, it puts so much pressure on management, where management doesn't want to disappoint, because if they disappoint, they're out of a job. If they disappoint, the stock goes down, employees are upset. New employees don't want to come. Stock options held by the employees don't get exercised. The morale goes down. It's just so there's so much sort of potential negative momentum that comes from just what I would say normally what happens. I like to say, sometimes it's going to rain. Sometimes clients cancel. Sometimes we add new clients. Business happens. It's not a straight line from the lower left to the upper right. So I always try to encourage management teams, say, you know what, let's just be upfront. Let's not give point estimates and say, this year we're going to make $2.03, 0.5. How about we just give a range? Within a band of outcomes that we feel comfortable about, and then not get so hung up on the number so much as how did we get to that number.
And let me tell you something too, that is one of Wall Street's fundamental problems, is much too short-term oriented. And when you're driven by those quarterly results, which really in the span of a company mean nothing. One of the things that destroyed GE, sadly, is the focus pressure on delivering quarterly results so much that people stopped telling Amelt the truth. And I got to get this numbers, and it became numbers oriented. The other thing is that getting the right metrics is key. When you talk about these black tail type events, one of the things that blew up on Wall Street was the measure they were using for risk, called VAR, value at risk, right? Yeah. Which is the amount of the maximum amount that you should lose from trading at any given time. It's completely blown up if there's a black tail event, which is why everybody was relying on VAR. So you do need that perspective of what's the right metric to honestly tell you what's going on. You can't predict black tail events by definition, but you cannot let yourself get trapped by metrics that inevitably won't capture them.
So I guess the other point is, if things are not going well, let's just tell people in advance. so that they can prepare for it and not be quote unquote surprised by the time the numbers.
Well, yeah, and also if you want to fix the business, the people on the inside have to be looking at it honestly too. So, you know, there's no, and you know, the market doesn't penalize for transparency in the long run. The market does penalize if you try to cover up what's really going on and you try to hide it from Wall Street. Buffett all the time writes these things criticizing himself, you know?
Yes. Listen, I think the most successful investors that I've known in my near 25-year experience is the ones that are humble.
Yeah.
I can tell you the street is littered with bodies of individuals that knew everything. And, you know, our biggest challenge is we're here trying to predict what's going to happen tomorrow. And, you know, somebody asked, I heard a great answer to the question, if I could have any power in the world, it would be to have tomorrow's newspaper. Because then I could position myself today and always have great results like Bernie Madoff did, right?
Yep.
All right.
Thank you very much, guys, and everybody listening. It was an honor to be in front of such a sophisticated audience that's doing good work too. I might add. So it's very nice.
Thank you, Jim, and thank you, everyone. Stay strong and let's keep up the due diligence.
Great way to end it. Thank you very much, Anthony.
Hey, you got to study history, otherwise you're doomed to repeat it, right?
Yes.
I'm giving a presentation tomorrow at the Value Investing Conference, and I'm going to be doing studies of things dating back to 2000.
Wow.
So, all right, sir.
Thank you very much.
Keep it up. Stay in touch.